In this week's video, we'll review the latest charts and data sets to help us answer the question, are stocks getting ready to take another ugly leg down? We've got an incredible amount of material to cover, so we'll be moving very quickly. The video is designed so you can use the pause button on your video player. This is a tweet from Thursday that we'll be expanding on in this segment. This is the VIX, or the Volatility Index. This is Thursday of this week, September 10th. All things being equal, if you're a stock market bull, on Friday you would prefer to see the VIX move in this direction. And that is indeed what happened. The VIX was down on trading day 6, 9.56%. It's been 6 trading days since the S&P 500 made its recent peak on Wednesday, September 2nd. Q&A in the upper left-hand corner of your screen, straight from the horse's website. The VIX measures the level of expected volatility of the S&P 500 index over the next 30 days. Thus, the VIX index is a forward-looking measure. The VIX speaks to volatility expectations over the next 30 calendar days. Thus, when the VIX is rising, volatility expectations of market participants is also rising, and that's expectations looking out over the next 30 days. As a point of reference, it might be helpful to know, how did volatility expectations change during the first 6 trading days after the major peak on February 19th in the S&P 500 relative to the change in volatility expectations from the September peak, also looking out 6 trading days? After the February 19th peak, the VIX over the next 6 trading days gained over 172%. Present day case, 6 trading days later, the VIX is up a little over 1%. This speaks to volatility expectations looking out 30 days, as does this decline here. This speaks to the rate of change relative to volatility expectations. If we look at the absolute level of the VIX in the present day, 6 trading days after the peak, is 31.38% lower relative to 6 days after the peak on February 19th. Thus, the rate of change in the present day is significantly lower, and the absolute level of the VIX is also significantly lower. Probably fair to say, at this point here, market participants were more concerned about increasing volatility over the next 30 days relative to where we are today. After the February 19th peak, on an absolute basis, this is where the VIX peaked. It's only been that high one other time in its entire history, and that occurred during the financial crisis in 2008. This is the level here in the present day. Remember last week we said there were some similarities relative to the present day level and the 2010 flash crash. Might be helpful to know, when the VIX peaked here in the 2010 case, the S&P 500 continued to fall. That's not uncommon. The S&P fell an additional 4.57% in the 2010 case. Something similar has happened in the present day. After the VIX peaked in the current episode, the market has fallen an additional 3.57%. S&P 500 daily, Thursday, September 10th. The chart basically looks identical since the S&P was only up 1 point on September 11th. This is unequivocally concerning. One difference: we were able to clear the blue trend line in this case. We couldn't do it here. We couldn't do it here. Some additional differences. Here, notice where price goes relative to all of these moving averages. Price relative to all of the moving averages. So far, we remain above all of the moving averages, including an upward sloping 50-day moving average. Also noteworthy, we talked about this last week, this trend relative to the bullish moving average crossovers is long in the tooth here. This trend is also longer in the tooth here relative to the present day. We're just now getting the moving average crossover in the cluster relative to the 200-day moving average. This chart is still concerning, but there are some differences as of September 11th. Covered this chart August 20th, airlines relative to the S&P 500. We said this is somewhat basing in a relatively healthy manner. That was the good news. The bad news was it was significantly below the June high. Here's the look of the chart this week, Thursday, September 10th. No material change on Friday. You can see it looks like it's trying to break out in a bullish manner. Internet stocks relative to TLT or long-term treasury bonds. Moving averages here, there's 3 of them on your screen. This case over here, earlier in the year, this is your hot knife through butter. No support from the moving averages. Look where we are in the present day. We haven't even hit the first moving average yet. The price relative to the moving averages here says something about the strength of this trend relative to the strength here. Here's the look at the end of the week, still sitting around potential support. We'll learn something on this chart either way. Numerous charts, we could show a ton of them, that are sitting at possible inflection points. Triple Qs, bad news, broke the trend line, bad news, price came down here during the day. We'll revisit this concept after we cover some S&P 500 charts. Tweet from this week on Tuesday, we said we were hitting a gap here. Here's the same chart on Friday. Here's the gap. The line shows you the top of the gap. Intraday, we dropped below the gap on Friday and closed back above it. This is still an area of potential support. We've been talking about price relative to this big gap here. There is also a small gap from August 3rd here in the S&P 500. If we zoom in to this point here, you can see the gap right here. It's between 3284 and 3272. If the market wants to go back and tag this gap, it's roughly 56 to 68 points below the close on Friday, September 11th. Telling us if we see weakness early next week, this is a reference point that we can use to learn something either way. We've been talking about the NASDAQ being a leader for several weeks, if not months now, off of the low. The S&P 500 did not move into this area on Friday. The NASDAQ did. Here's the same basic gap from August 3rd. Intraday, we went into the gap and rallied. This is the triple Qs. The exact same thing happened in the center of the screen for the NASDAQ Composite Index. Same thing happened for VGT, a tech ETF, into the area and bounced. The S&P 500, as we've noted, has not gone into the area yet. Possible. The NASDAQ was also the leader in this. The S&P will need to go back and tag this gap. We'll learn something either way relative to these gaps. No predictions here that they're going to hold, but these did hold during Friday's volatile session. Like the S&P 500, growth stocks may still need to backtrack into that gap. All of this tells us to keep an open mind about better than expected outcomes. We'll also learn something relative to the gaps in each case. If we don't hold, like any support or resistance level, the longer we move to one side or the other, the more relevant it becomes. September 8th of this week, here's a tweet after the close, said the S&P 500 is trying to make a stand near this trend line. How does the same trend line look at the end of the week? Nothing magical about this trend line. It's 1 point of reference, but as of the close on Friday, price is still holding in that general area. You have a lot of charts with inflection point looks. What does that mean? This is bonds versus stocks. This is potential resistance. We could either move in this direction, or if we get a breakout, move in this direction. All of these charts speak to the need for maximum flexibility. Here's how this chart looks as of Friday's close. This is what conviction to own bonds looks like relative to stocks. It would be a steep slope. We could draw a trend line here. This is somewhat of a breakout, but then we go sideways. This looks like it's trying to break out above this particular trend line, but not in a convincing manner. This ratio was up 0.1% on Friday. Home builders, one of the leaders off the March 23rd major low in the S&P 500 index. This is home builders relative to the equal weight S&P 500 index, close Thursday of this week. This consolidation here takes place below this upward sloping trend line. This consolidation also takes place below the trend line. Present day is consolidating above the trend line. How did this chart look as of Friday's close? Even better. On Friday, the ratio was up 1.12%. It moved in this direction. Here's another inflection point look, home builders relative to bonds. This chart also moved in the right direction. It was up 1.43% during Friday's session. Similar concepts here. Present day consolidation. This here is above. We're also above as of the close on Friday. This consolidation takes place below, and then really bad things happen. Wouldn't say this is a major concern, but we'll show why it's concerning. QQQ relative to GLD. This is a look at the chart this week. If we only look at things from one perspective, our perspective can be skewed. Unquestionably, this looks like a failed breakout, and it's concerning. However, this is Thursday. Here's the rally off of the March 23rd low in this ratio. This is still an uptrend that's intact. This is a higher high relative to this high. Thus far, this is a higher low relative to this low, and this trend line, as of Friday's close, is still intact. Major inflection point look, maximum flexibility. Let's talk a little bit about why a failed breakout would be concerning. Now we're looking at the S&P 500 relative to physical gold. This is 1980 on the left side of your screen. This is the secular bull market on the bottom, S&P 500 from 1982 to the peak in March of 2000 where my cursor is. This is the S&P 500. During the secular bull, for the most part, stocks outperform gold. This period here where stocks don't do much, notice the difference in the index. And in this case, the index would be S&P 500 relative to gold, or the ratio. Here's the present day look. This is 2018 here. Hard to make the argument that this look here looks a lot like this look here or this basic look here. Not necessarily a showstopper, but if you're expecting a secular bull, this is really not the look that you want. You can see here the S&P 500 does well with this look here in the ratio. And you could make an argument that this looks like this, this, and this. But if you zoom in on these three periods, this looks worse. Our SPY TLT chart that we've covered in the past also has a concerning downward sloping trend line look to it, dating back to late 2018. And notice here, we haven't even gotten back to the trend line here. That's telling us that the S&P 500 is even weaker here than it was here and here and here. Now, this chart may improve, but it hasn't improved yet. This chart's dated September 10th. We're not anywhere near this trend line. This chart helps us keep an open mind about much worse than expected outcomes for stocks. Always important to remember, your last trade or your allocation is a sunk cost. Those are decisions that you've made in the past. Our job is not to defend those decisions. Our job is to protect and grow our capital. Maximum flexibility. This is kind of the bad news look, and we said it needs to improve. Well, in the short run, there has been some improvement. SPY has outperformed gold dating back to August 6th, but we need to see more than that. Here's a close-up of the chart on September 10th, Thursday of this week. There's really no way to rationalize this away. This is a concerning look right now, and we're respecting it, and it helps us with flexibility. If you're a client, it's important for you to know this is the way that we have to think over here on the left side of the screen. This is the S&P 500 index here. This is a DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. LLC. Scenario number 1, and not necessarily the highest probability scenario, just the first one we're covering. If the S&P 500 can't make a stand here and near this area here, and this chart doesn't improve, and this chart doesn't improve, and the SPY TLT chart doesn't improve, then it's quite possible we could be entering a period where the stock market greatly underperforms both bonds and gold. Right now, support in this area is holding, and we're still above those gaps. This is simply contingency planning. We also have evidence in hand that tells us we should keep an open mind about support holding in this general area. Stock market could move if we hit this target here, this probabilistic target. This is roughly a 9% move from this area down here. Even in that case, if the stock market gets all the way back up into this area here, and this chart and the SPY TLT chart on a longer term time frame don't close these gaps at least, we'd really like to see them get to the other side here. And if we get momentum divergences up here, then we have to be willing to sell into strength. And we have to be willing to sell into strength and start migrating to bonds and gold. If charts like this can improve, and the stock market gives us a convincing push higher, then it's relatively easy. When the market gets up into this area here, you're in no hurry to cut or get rid of your stock-related positions. That's all to be determined. As we always say, it's incredibly important to be open to a wide range of outcomes, and that requires maximum flexibility. You have to be willing to get rid of your stock positions quickly if the market fails in this general area. You have to be willing to take profits up here if the things we're concerned about don't improve. RYT, equal weight technology, another possible inflection point look. Similar situation, stocks versus bonds. RYT relative to IEF, this is an important area. SCHX, which is basically SPY, relative to IEF, has two areas very, very close by that could act as potential support. Upward sloping dotted line and the June high here. Friday's close above both lines, or at least on this line. What once acted as resistance, may now act as support. Notice we use the term may. Everything that we just said about the previous chart applies to growth stocks SCHG relative to TLT. There's also some other areas of potential support down here, including extending this trend line, which is parallel to these two lines here. There's nothing magical about any one particular trend line or level. You're making decisions based on the weight of the evidence. This is part of the weight of the evidence. There are no absolutes in technical analysis. And we also have something known as failed breakdowns, and we have something known as failed breakouts for a reason. Very, very easy to get whipsawed by trend lines and support levels or potential support levels. The longer a level is broken or exceeded, the more relevant it becomes. A lot of the charts that we're looking at, including credit markets and ratio charts, really haven't had a lot of change relative to the charts that we covered on August 20th, including this one. The Dow was sitting right around the June high here. It's unquestionably more precarious, but we're still sitting around the June high on Friday, September 11th. Even below that, here's a gap, here's a gap. You can see the stock market has a very long-term memory for gaps. Even gaps that are filled can still be relevant. This is another inflection point type look. Take a look at this chart, price and the moving averages on August 20th. Here's the same chart on September 10th. And remember, the S&P 500 was up 1 point on the 11th, so it really doesn't look any different. So far, look at this. This, so far, doesn't really look anything like this hot knife through butter look here. That may change, but it hasn't changed yet. Even this bounce above the 50-day moving average is better than what we saw here. Showed this chart on August 20th. NASDAQ QQQ, NASDAQ 100 relative to TLT. Here's the same chart on September 11th. Really not a lot of change. This looks like a bullish breakout, and thus far, this could be called a retest attempt. Retests can pass, or they can fail. It's also noteworthy, way back on August 20th, we said bullish breakouts can fail. We cited this example here, bearish breakdowns can fail. Not making any assumptions relative to what happens to this chart or any chart that we cover this week. We just have to know, how will we handle a move in this direction? How will we handle a move in this direction? And how will we handle a move in this direction? And we have to understand every single case and scenario in between in some shape, form, or fashion. It's also important to keep in mind, this is a study that we covered on June 3rd, a bullish study. Maximum drawdowns are calculated from the date of the study. In that case, the signal was given on June 3rd. The S&P 500 closed at 3122 on June 3rd. We're nowhere near 3122, telling us we haven't seen anything to negate this study and the vast majority of studies that we've shown in these videos. There's not a lot of improvement on this chart, and this chart is still concerning. Last trade is a sunk cost. It's a chart we covered last week, talking about the gaps between stock and bond performance. We started covering a lot of these charts on August 20th. There really is nothing here yet definitive. Stocks and bonds have basically treaded water relative to each other since August 20th relative to Thursday of this week. The same was basically true on Friday. This is noteworthy here. If market participants are very, very concerned about longer-term economic outcomes, at some point there is going to be more conviction to own defensive assets. That may happen very, very soon. Hasn't happened yet. Similar situation here. We covered this JNK TLT chart back on August 20th. If we looked at the same chart this week, it really hasn't changed a whole lot. Why? JNK and TLT basically been trading punches. JNK has slightly outperformed TLT, but not by a wide margin. At any type of inflection point, near a top, near a potential bottom, it's extremely important to continue to trade the chart in front of us. RSP versus SPY, August 20th. Close on Friday, September 11th. It's possible, I could show a lot of charts like this, that we're seeing a rally that's trying to broaden out again. Tried to do it here, didn't do it successfully. It's also possible that this is a failed bearish breakdown. The market wants everybody to liquidate their RSP here. A lot of times when that happens, you move rapidly in this direction. Not a prediction. But we have to admit the look of this chart here is different than the look in here. Similar situation here. Industrials, they've been a laggard. This laggard is now trying to break out relative to the other sectors. Remember way back here we said if you own tech and growth stocks, the reality is you want them to underperform at some point because the rally has to broaden out. Why? Because at some point the economy has to improve. And that's when the rally will broaden out. This is a broadening look. This is a broadening look. Will we continue to get a broadening look? We have no idea. But this, the chart in front of us, is a broadening look that we have today. Similar situation, we covered this chart in detail on August 20th. Transportation relative to the S&P 500. Notice a lot of these are economically sensitive transportation stocks, economically sensitive home builders. How does the exact same chart look today? This is a breakout that occurred on Friday. This is earlier this week. Here's the close on Friday. This is also a broadening out and healthy look potentially. We also covered this chart, SP low volatility relative to the S&P 500 back on August 20th. Really no big change relative to the look. The S&P 500 SPY has slightly outperformed SP low volatility since August 20th. If this support holds here, it's telling us to keep an open mind about better than expected outcomes. Holding at this gap here on Friday tells us to keep an open mind about better than expected outcomes. This big pop in the VIX, which is followed by a big decline in the VIX, tells us to keep an open mind about better than expected outcomes. This data set here tells us to keep an open mind about better than expected outcomes. And this data set here tells us to keep an open mind about better than expected longer-term outcomes. Not surprisingly, relative to what we've seen in this calendar year, we just experienced the fastest 10% drop in NASDAQ history. It took 3 trading days. Here are the other fastest drops in history. 6 months later, the NASDAQ was higher in 91% of the cases. 12 months later, the NASDAQ was higher in 90% of the cases. Median gain 6 months later, over 20%. Median return 12 months later, over 30%. There's a long list of things to be concerned about, but most of them right now are still inflection point looks. This is an uptrend. This is a bullish look here, meaning the burden of proof is on the bears. They have to take out these inflection point looks. They may do that, but they haven't done it yet. This gigantic gap that's still here, because this chart has not improved much since August 20th, is telling us that it's very, very prudent to respect the fact that the bears may indeed prove their case. But we really haven't seen anything yet that damages all of this in a significant manner. It may happen very, very soon, but it hasn't happened yet. All of this applies to data sets, studies, and charts. Near inflection points, these concepts are even more important. In the markets, it's incredibly important that contingency planning and scenario-type planning looks at tactics, thinks about strategy, but it also has to think about the mental aspect of making decisions under difficult circumstances. As long as we remain flexible and open-minded, no matter what happens, we'll have a much higher probability of handling it well. And we all know this, the only way that we can trade the chart in front of us is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.